National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice. And today, what every producer should know about taxes with special guest Ken Davis, CPA. And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Welcome everyone to the Business Insurance Zone. I'm Steve Savant, and we're broadcasting live to a nationwide audience of financial professionals right out of Fountain Hills, Arizona, home of America's largest fountain. And with me today, all this week, oh my goodness, poor Ken, he has to put up with me. Ken Davis, CLU, ChFC, CFP, CPA. Wow, Ken, welcome to the show.
Thanks, Steve. Good to be here.
Well, it's good to have you here because this week, if you haven't seen any of our previous shows of this week, Monday through Thursday, you need to go back out on www.brokersalliance.com. As soon as you come to our homepage, click on the on-demand red button section. It'll put you right in these prior shows because we talked about a lot of cool things that'll position your practice to sell our tax advantage products. And part of that is what we've been doing all this week, but talking about AXA's excellent 1040 transparency that points out areas where you can save significant taxes for your client by using our tax advantage and tax favored products, as well as we have this nice digest from Lincoln Benefit Life. I've been using this, I think, over a decade now.
Well, yeah, I keep it in my drawer. I put it back to back and laminate it, so I have it.
And it's excellent. It's a digest of the 2012, and I wish you could see it a little bit more on the camera, but that's what this is excellent. And you can order this right from the Lincoln Benefit site, or if you can't figure out how to do it, and I'd be there for that, you can call us and we'll send it to you on an email attachment. And you can write us at thebiz@brokersalliance.com, and we'll make sure you get that. Well, Ken, today we said all these things about taxes. I mean, we were all over the board: Social Security, capital gains, you name it, qualified plans, everything that had to do with tax management. I like that we're kind of managing this.
AGI management.
Yeah, AGI management.
Yep.
But I want to talk about today the tax issues from a CPA's point of view, life insurance and annuities. Let's do annuities first, because then I might segue into a MEC life insurance and then
Right.
tax-free. We'll keep it all tax in the tax sense.
Absolutely. Well, basically, when you look at an annuity, there was a time back in early '85 where it used to be what we called last in, first out. In other words, first in, first out. So if you put $100,000 into an annuity and it was 105 at the end of the year and you wanted to take $5,000 out, well, back then you'd take $5,000 out, and that was $5,000 of your tax basis. That originally $100,000. It was a return of your principal, and you wouldn't be taxed on that, but your basis would go from $100,000 to $95 until you've used up all that basis. Well, the government, for whatever reason, came in and said, we don't like this, so we're going to do last in, first out. So the last into the pot is your income.
So we all have to pay taxes on the interest first because
Right.
they changed the rules.
So in the same example, if I take $5,000 out, that entire $5,000 is all profit, and I have to pay current income taxes on it. If I took out 10, first 5 is taxable, the second 5 is return of my premium or principal or tax basis. And so that continues to decline as I keep taking that out. Well, so that's how, when we take just plain withdrawals and not liquidations out of an annuity, we have to look at these layering rules. Well, what's interesting is if I take that deferred annuity, let's say I put 100 into it and it's now grown to 150. And let's say that I annuitize it over 10 years. Well, the government says I take a straight line basis. I take the $100,000 of the original basis, not the 150, but the 100, divide it by 10. And so I get to deduct $10,000 from the earnings. So let's say I had $12,000 a year coming out of that annuitization. The first 10 is tax-free, and then $2,000 is taxable. So unlike withdrawals, annuitization has a whole different set of rules on taxation.
Now, there's a lot of debate between annuitizing, though, Ken, and taking withdrawals. So our issue is never do the debate, do the math on the 1040 to see if there is actually some leverage, because we're getting FIFO treatment on a thing that should have been LIFO.
Right, and here's how we can get rid of the debate. We're going to do a whole show on layering annuities at some point. And basically what you do is I could have 4 different annuities of $25,000 each. Okay, that $100,000 now is 25. So let's say I put it in a defer on all 4 of them for a while. And then 10 years from now I say, okay, I'm going to take that first 25,000 and it's now grown maybe to 35, say, and I'm going to annuitize it only 5 years. Well, because straight line, I get to take my original basis at 25, divided by 5, right? And I get 5,000 a year tax-free. It's only the excess. Well, in today's low interest rate environment, the fact is most of it is return of principal. And in the meantime, I continue to defer taxation on these other 3. And of course, when the 5-year immediate's done, there's nothing left. We've fully amortized. It's like a principal and interest payment on the loan. Now we're the banker. And now I go to my second annuity, I annuitize that for 5 years. And then you just go through this year by year. Well, what that does is you get to utilize your tax base quicker and have income, whereas a withdrawal, it may very well 100% of that's going to be taxable as long as I'm taking out. So there's some tax management, and of course, if it's not taxable, it doesn't go onto the front page of the return, doesn't hit adjusted gross income, so that's going to have an impact on taxation of Social Security that we talked about in our other show, and deductions, credits, exemptions, all that other stuff. Because AGI, as we found out in the earlier shows, and I would welcome our viewers to go back to the earlier shows this week, we'll see why managing AGI is important. So this is by using annuities, we get tax deferral, but if we choose the right way to take money out of the annuities, we can manage our taxation even more so.
So when I'm looking at the annuity, I like the idea. There's a debate whether I should do withdrawals or it's better to annuitize, because once we turn the annuity button on, the income's kind of locked.
Well, yeah, and the interest rate's so low that I'm not a real fan of annuitizing over life expectancy right now because of that issue.
But maybe shorter, like you said, 5, maybe 7,
by
10.
doing combinations of annuities and layering, we can get almost like a laddered bond portfolio or CD type of thing where we're taking segments and annuitizing, not the whole thing. And here's the cool thing. 5 years from now, when we do the second one, and if we did 5-year annuities, penalty's gone, brand new opportunity to roll into a new annuity at higher potentially interest rates, right? So that kind of an inflation hedge, right?
Yeah, hopefully.
Well, I think it's likely in 5 years with what's happening with the budget. So then you can lock in it, and the agent gets to make a new commission on the new sale.
Well,
We don't like that, though, do we?
I'm totally into that, as long as it's good for the client, Ken.
Of course.
I'm sitting with Mr. CPA, I better say it, right?
Well, I already said it, and that is that we're reducing their taxes, and,
Right.
and we're doing inflation protection, so it works for everybody.
Well, I when I think about annuities at large, and of course SPIA rates are terrible. I mean, are about as on the floor. And I'm even looking at some of the index products that actually give you immediate income that are competing against this now and actually doing
Right.
quite well. So that's a whole other
Yeah,
set.
that's part of what we'll discuss in this layering of annuities is the use of lifetime income benefit riders, and even using index life for some of the long-term period out there. And we'll talk about some of the downsides as well at that point. That it's not all hunky-dory, but it's a good strategy.
And we're not going to talk about the actual, like the difference between variable annuity, index annuity, current assumption, interest rate annuity so much today, because our shows, we'll get to that on our annuity show when we do all this. But what we're talking about today is mostly the tax benefits, the advantages, the favoredness
Right.
that these annuities have. And they become a player. Once everybody got off what's the total net spendable take home? People are managing in the journals and all these other periodicals that hate annuities because they hate buy and hold positions like this.
Now, one of the other things from a tax perspective is if we do a lifetime immediate annuity, one of the rules on deferred annuities is when we start to take income, we have to pay not only income taxes, but if we're less than 59.5, we have a 10% penalty, right? But if I take the annuity as a lifetime income, that qualifies under Section 72T to avoid the 10% penalty, right? So we can, in fact, manage that if they're a younger person as well.
Now, how young can I be?
Any age.
So it's not the 55.
No, it's the lifetime income. But I mean, if logistically, I mean, practically, if you're 30 years old and annuitizing your life expectancy, you're not going to get much income.
That's pocket
So
change.
it's going to be as you get closer to 59.
I just saw an annuitization, and I can't make stuff like this up. It comes across our office, and he goes, I annuitize it. Then as soon as he annuitized it, right, Before he did it, I guess he called J.G. Wentworth or somebody to see if he could sell his payments to get a back lump sum back into his pocket, right? Now, this is where I get into the odds are J.G.'s not going to give you more money.
Generally not. I wouldn't expect to.
They don't make money unless they give you a little less, so you get the immediate impact of the lump sum.
Right.
Everybody's playing today, and this is just one organization, they're a good organization. They're helping people get liquidity. Everybody's trying to figure out where the interest rates are going and all this and everything else. But today's show is not that. Where's taxation going? See, this is where we're trying to figure out, is there any kind of, prophetic utterance coming from Mr. Ken Davis, CLU.
I'm not a cow, an utterance.
An utterance, yes. I'm looking for something from the divine. I mean, religion has the Bible, but Ken has, the tax code. I mean, he reads it every day in his. Yes, we're looking for utterances. So but that's what I'm talking about today. We're not talking about so much the annuity itself, but the taxation, the actual advantages. And we've done this time and again using AXA's great 1040 laminated system. It's really easy to do. Again, call us. We'll give it to you absolutely free, or write us. I'll get it to you. It's really a great thing to help us through sales and understand taxation.
Well, and here's the other thing is there's been a lot of articles that lambast annuities. And in fact, I'll remember one in the late 90s where the front page of Forbes magazine was just all over variable annuities. The matter is those articles never ever talk about annuitization or doing any of the mitigation strategies that we talked about. And if they did, the conclusions would be very different in a whole lot of situations. So we have to fight off these misconceptions and misperceptions of annuities. But annuities, no doubt, are on the low end of the tax benefited product area.
And what I want to know is if I can show time and again that I have tax advantages and there's a favoredness to annuities, I'm going to use them. It's as simple as that.
Right. Well, and one other caution is the code actually defines who the owner is in the taxation based on whether they're what they call a natural person, a human being. They don't call us human beings, they call us natural persons. Don't you love that? And then they have corporations, partnerships, trusts are non-natural persons. And guess what? The tax deferral of annuities, if it's held by a corporation, is not tax deferred. It is fully taxed by 1099 as you go.
I'm thinking of a corporation would only be doing it if the rate was really great. I guess we're going to get any deferral. It would just be, can those rates be?
And that may make sense.
Right. Well, I'm always looking at annuities. When we come back on the show, we're going to talk about annuities are kind of treated in this tax, ordinary tax. We're going to talk about modified endowment contracts with life insurance that are taxed almost exactly, except for the death benefit, exactly like annuities. Right. You're listening to the Business Insurance Zone, the talk show that focuses on insurance products in your practice. You can write us at our email, thebiz@brokersalliance.com, or call us toll free, 1-800-290-7226, extension 147. When Ken and I come back, we're going to talk about MEC or not to MEC. That's the question, right after our message from Brokers Alliance.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high definition broadcasting with online social media. Your search just ended.
Back everyone to the Business Insurance Zone. I'm Steve Savant, your host, financial color commentator, insurance columnist, and interviewer extraordinaire. Before going forward with any of the tax strategies that we're talking on the show, always consult your CPA, your tax attorney, and your broker-dealer compliance department. You can call me toll-free, 1-800-290-7226 for any of your questions or quotes on life insurance, DI, annuities, LTC, and group pension plans. It's not what I know, it's who I know, and that's why I have Ken on the show, because Ken is all-knowing. I know, I don't want to get too far here, because his E&O doesn't stretch that far.
Yeah.
But he is not knowledgeable, CLU, ChFC, CFP, and CPA. Ken, what I'm talking about, we talked about tax deferral, ordinary income tax on annuities, and we're going to do that show you talked about. We're going to do a whole show on this. But then we kind of graduate over to a tax-like idea called a modified endowment contract using life insurance. Now, generally, when I heard MEC, I thought that was bad, right? There's some reasons why I might want to look at this, right?
Right.
So I'm asking this, if we had to do this segment, it would be Shakespearean. It would be to MEC or not to MEC? That is the question. Talk a little bit about modified endowment contracts using life insurance, because they pretty much have similar treatment to annuities.
Well, I'd like to do a little bit of histories with this stuff, because then you start to see why the tax law was put in place in the first place. Back in the early 80s, some wealthy people were doing huge dumps of money into life insurance policies. We were getting outrageous interest rates back there, 10, 12, maybe 14% on fixed interest rate products. I mean, it was amazing. Of course, inflation was through the roof as well. But they just dump the money in. It's all tax-free. They take out their withdrawals tax-free, and then their loans tax-free, and tax-free death benefit. And quite frankly, Steve, that's why the CPA and me finally relented and got his insurance license, was to do single premium whole life products for that very reason. It was all tax-driven for me. So then along comes Congress and said, we don't like this. Our intention, there's a social good to encourage people to buy life insurance and to make it affordable long-term by paying more in and letting the life policy slowly but surely replace itself with cash value. But they didn't like this thing that really, if it looks like a duck and quacks like a duck, it's a duck. Well, it looked like an investment, not an insurance policy, and it really primarily was. So they said, okay, we'll still let you do this, but we're going to make you spread your payments in over a period of years. So in the mid-'80s, we got new tax acts that came through, and they looked at this very hard at that point. And it did two things. One, it did the MEC test, the Modified Endowment Contract test, and whether or not it's even a life insurance policy or a MEC, where it gets none of the tax benefits. Well, the MEC is this, okay, you stuffed it a little too quickly with cash. You went over the thresholds, you violated the rules of what a MEC is, and so now we're going to have some tax consequences to that. And the tax consequence is pretty simple. A MEC is a hybrid for tax purposes. Part of it for estate tax purposes, or at death, all of the death benefit proceeds, just like a regular life policy, are tax-free, okay? Unless you violate transfer values rules or sell it or things like that. For income and access to cash during life while you're still living, now the rules from annuities are exactly the same. So cash and income and accessibility during life, liquidity is an annuity rule, and at death it's tax-free. So let's think about why that's important. Well, if I used like our $5,120,000 estate tax unified credit exclusion amount equivalent, and I had a really wealthy client that wanted to utilize it before it goes away at the end of the year and wants to make sure they lock it in, they can put it into an irrevocable life insurance trust, that whole amount of money, and they can fund a MEC inside the trust with that lump sum. Well, the cool thing is that is great leverage instead of paying it over a period of time. It's now a MEC. Do we care that it's a MEC? Heck no, because does our client get access to the cash value? No, it's in a trust. They've given it away. It's for the kids. It has a sole purpose of being indemnification, life insurance, pure life insurance for the kids. And so the MEC status is perfect in that environment because we get it all in at once. We're utilizing our full credit today and not having to worry about it being taken away in 2013 after the elections are over. So there's a great use of a MEC, is one that once it's in a trust, we don't care. Another thing is the client says, well, gee, I don't want to pay for all the ongoing insurance costs. I want to get as much cash in its policy as quickly as I can because I'm in older years. But they still want access to the cash just in case, in an emergency. So they don't think they're going to use it, so they do a lump sum, they hold the MEC inside their estate. It's really intended for the kids, and most likely will go to the kids. But just in case, if they really need the money, they can take the money out later. Now, is that a big problem? No, because we got a large basis in the product already. If we put it into 4 different products like we did last time and annuitize part of it, the costs are relatively minor. But is regular life insurance a better deal? Absolutely. But MECs can be tailored and used appropriately.
In fact, actually, I super funded a MEC the other day and put the extra rider, cash rider on it.
Yeah.
Then went from doing traditional single test to cash value test. We were able to compete. I know this sounds whacked, but we were right there with the 7 and 10 year rates of our fixed annuity products.
Wow.
So, I mean, think about that. We're just talking about, and then I get the bonus of the death benefit going free, whatever I didn't use. So there's some positions using this. Now let's just shift a little gear. Now, we like the idea of tax-free anything, right? I mean,
right.
I love tax-free.
Sure.
So if we do a non-modified endowment contract and we do the test, we keep it in force for the life of the client, and we've suppressed the death benefit down to the TAMRA regs, which is what we were talking about when you were referring to the 1987. The Technical Corrections Act really manages TAMRA to the ground, defines what insurance is, what's investment, and once we've learned how to play and mitigate that, we're just using the law as it was written now, and now we support that, and we can get tax-free withdrawals and policy loans of gain out tax-free as long as the contract's kept in force. And remember, every year we're going to have to go back to the carrier. I'm so sorry to say this, Ken. We're going to have to go back to the carrier to find out, hey, what can we take out?
Right.
Because it's all going to change every year, and so I never know from one year to the next. And if I'm going to use tax-free, like we've been looking at some of our annuity laddering, I noticed, Ken, you were putting on life insurance as an income after the 10th year.
Well, yeah, and we'll get into it when we do the layered annuity combo annuity. But one of the downsides is as we annuitize different pieces over time, the tax basis relative to the now account value gets smaller and smaller. So we started at 25, now it's 35 and 25, 50 and 25, 75 and 25. So your basis is 25 and the growth keeps going. So when I annuitize later, it doesn't work quite as well as the first time I did it. Well, we both know that life insurance from a cash value standpoint needs at least 10 years and even better about 15 years to percolate. Okay,
Absolutely.
so we get our early withdrawal penalties gone, we grow it, the tax benefits overcome the expenses and stuff like that. And now the life insurance sings at 15 years. Well, if I did 3 annuities and then the final piece was an indexed life, well, now it's not a guaranteed income, but chances are over 15 years an indexing strategy is going to look pretty good. And so now we can actually take withdrawals out, but we're withdrawing our basis. It's first in, first out instead of last in, first out. So no taxation withdrawals.
A privilege that
right.
life insurance has.
Life insurance, annuities don't. And then we can borrow, or we can borrow the whole thing from the start, and that's all tax-free income. And then when we pass away, it all comes out tax-free. So if they're 65, did 3 annuities, it gets them to age 80. There's a pretty good chance that they're going to pass away and get the full tax-free benefit of that. If they don't, they're now taking withdrawals, and they're not worried about the tax basis anymore because it's all tax-free loans, right?
And even if you were taking all policy loans, let's say you're on one of those arbitrage or participating loans that indexed UL does use.
Right.
I mean, even that, again, tax advantage, because whether it's as long as it's tax-free, that's I care about.
Right.
Now, if it's better to do arbitrage, we'll look at that. We're going to do a whole show. I think I'm going to have to do a show on arbitrage loans because Ken and I are going to tell you something nobody else is telling you, and I'm telling you, people are going to have major league whiplash after the show because they're going to go, no way on this, because we're going to tell you, heads up on arbitrage loans. You better make sure you know what you're doing. The math may not be on your side. I'll comment on that. Now, Ken, when we're talking about it, we said annuities, then life insurance, that's a MEC contract that taxed, and from a tax point of view, looks like an annuity, except for the death benefit. And then life insurance, that is a non-MEC policy that can come tax-free.
Right.
Now, you were talking earlier in the week, depending upon when we take this money out, it'll have other impact on other products. So when I look at that, that's a big feature. Deferral's one thing. I might be able to really make this happen, take constructive receipt, depending upon when I need the money, and make it in concert with my money coming out of my qualified plan.
Let me just interject real quickly. When I present to clients or to their advisors, I talk about the 1 dot, 2 dot, and the 3 dot. 1 dot is I get tax deferral for annuities, nothing else. And the MAC, I get 2 dots. I get tax deferral and tax-free death benefit. The 3 dots is life insurance, tax deferral, tax-free death benefits, and tax-free distributions. So I've got the 1 dot, 2 dot, 3 dot benefit package kind of thing. So, and in terms of this layering, it was actually you that taught me years ago. I remember sitting down and watching you do the whiteboard, where we're mixing and matching different products. We've got our qualified plans, but before 59.5, I'm taxable, and I have a 10% penalty. So where do I get the rest of my income? Well, if all I did is qualified plans, that's my only choice. If I had a life policy that I funded over 20 years, I can go to that now and take the income out early without any penalty. Then we can use the deferred accounts all the way to 70.5. So the benefit of deferred accounts is the longer you deferred, the time value of money concept, the longer you get to use those taxes to earn money, the better. And then we have the forced distribution at 70.5. So by layering in life insurance with these qualified plans, it works even better.
We've been talking about the taxes, tax advantage, and the tax favorite of using the products we sell. Remember, you can watch this show and all week's show in HD 1080p. Just hop out to our website, www.brokersalliance.com. As soon as you come to our homepage, click on the red button that says On Demand and click right in. You'll be right in there. And of course, we're on all our social networks, the same show, Vimeo, YouTube, LinkedIn, Twitter, and Facebook. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get into the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. The Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.